Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland here with John Paul Hamstead, our Director of Passport Research, as usual, here to bring you the news on what has happened in the spot market and the rest of the freight market this week. This week we did have our first big earnings report, but first, before we dive into that, we need to talk about the market. JP, what have we seen this week in the market so far?
Yeah, we've seen trucking markets continue to settle a little bit. So national average spot rates down slightly, tender rejections, cooling slightly, still around 25%, which is obviously quite high. But one of the things you'll notice if you go into Sonar and pull up sort of the major outbound markets in the country, places like LA, Dallas, Chicago, Harrisburg, Atlanta. All of those are going to be below the national average, actually.
So the bigger markets are actually, pulling the averages down.
The bigger markets are getting more and more well supplied with freight. But lots of other places in the country have extraordinarily high tender rejection rates. Including the sort of remote, obscure markets you would think of, but also places all through the middle of the country, really.
Yeah, roughly 65% of the markets in the country have a rejection rate above 25%, which is why that rate is able to withstand a lot of those bigger markets showing some settling.
Yeah, and one of the things that we were talking about that I do want to clarify about the data set, we were talking about that this morning, is that OTRI.USA, the national average tender rejection rate, is not just averaging the OTRI of all the different markets. It's recalculating from every tender. So there's no question of like how are the markets being weighted or anything like that. It's starting from sort of the raw data. So that's important to keep in mind. But yeah, I mean, I think that October, this kind of is normally a lull before capacity gets really constrained in peak season, when you have holidays and drivers' optionality starts being a little bit sort of narrowed, and when shippers get more frantic, right?
Yep.
So, honestly, the key, there's some sort of key things that tell me that carriers still have like really strong pricing power.
Right.
So if you look at something like outbound LA, if you look at like say LA to Las Vegas versus LA to Stockton, okay, Stockton, attractive market, important second tier warehousing district, a lot of outbound freight. Las Vegas, unattractive market, huge backhaul market, rates going out are usually low, right? So in April and May, when the entire freight market was soft, when capacity was loose, when rates were crashing, there was only about a 22-cent per mile difference between LA to Stockton and LA to Las Vegas. And that was based on the characteristics of Los Angeles. There were more trucks than freight. People had to take what they could get. The carriers weren't able to exercise optionality. Fast forward, the spread goes like this,
right? And
now there's like $1.40 per mile spread between these two, because carriers are saying, hey, and they're charging more to go into Las Vegas. The carriers are saying, hey, if you want to send us into this market that we don't like, when things are hot, we're going to charge you far more for it.
No, I think that's a good point. We've seen this exaggeration. We talked about it a little bit in weeks past about how some of these bad markets have gotten worse during this whole thing, because carriers, like you said, don't want to go into some of these
bad... Because there's an opportunity cost.
Exactly. But Stockton's not traditionally like anything going from Los Angeles to destination. Typically on the short haul is not a great lane for a carrier, because there's inherently imbalance there just because of the nature of Los Angeles.
Yep.
Northern California is still a backhaul market compared to Los Angeles. But it isn't necessarily a Las Vegas backhaul, where they don't produce anything whatsoever.
Yeah, and so like we look at things like tender rejections, we look at spot rates, we look at volumes to try to figure out like what state the market's in and who has pricing power. But I think the difference between when you have the same origin and you have destinations with two different characteristics, if carriers are able to pick which lane they want to go in because there's plenty of freight, and they're able to drive, make those prices on those lanes diverge, then that's telling you who's really in control of the prices.
Exactly. in Florida, we saw the same thing. Outbound Florida rates definitely, there's a water level going up, but that market has become much worse in comparison to some of the other other lanes specifically.
And so I just think going into what's considered like peak retail season, the market's obviously in a very healthy place. It's still very favorable for carriers. It's not. I wouldn't say things have gotten much more expensive since the beginning of September necessarily, but carriers should be making money. They should have plenty of freight, and I think what's most important is sort of the underlying fundamental capacity dynamics that we believe will continue to hold through bid season.
Right. And we had an interesting development this over the last couple of months with orders. We're tracking orders, Class 8 orders, van order, trailer orders, et cetera. And preliminary reports. Alan Adler reported that trailer orders far surpassed Class 8 truck orders here in September, at least on the the early report side, which is not something that normally happens. And a lot of this is kind of like based on driver recruiting issues, where they're not able to seat the trucks that they have. But at the same time, we're also talking about how carriers may be more willing to invest in trailers at this point because of, you have all sorts of operational things that you could commit to in terms of dropping hooks, et cetera. So some of the signs are there that carriers are optimistic, but they're not necessarily going all in on the current rate environment.
Right, that makes sense. And they're not necessarily optimistic about their ability to find drivers.
Right.
They think that there's business to be had. They want to free up their tractors to run more miles, right, with more a higher trailer ratio.
Yep.
That makes a lot of sense. And I would just say that power-only brokerage has been a growing trend over the past, call it 5 years at least. I've seen more and more companies try to solve, the issue of fragmenting carriers and getting them dropping hook freight and figuring out how to do that.
Right. So let's divert a little bit here. We had our first big earnings report, and J.B. Hunt comes out with a little bit of a miss on expectations, and I don't put much credence in expectations at this point, especially in 2020. But at the same time, I think breaking down what we saw in their ICS division. The brokerage side of things is pretty crucial at this point because, I think a lot of people look at the tender rejection rates and you just assume, oh, everybody's doing great that's in trucking. And that's not necessarily the case, especially on the brokerage side. Right.
So when tender rejections go up a lot, that means that carriers are playing the spot market, which means that, there's a lot of consequences of that. But what ends up happening is that your margins on contracted freight end up getting squeezed. The spot rates are going up. Meanwhile, you agreed to move freight for a certain price. Maybe you negotiated that in Q1 or Q2 of 2019, which seems like forever. Or 2020, which seems like forever ago. Right. And now that's kind of coming home to roost. So just to kind of go through some of the numbers on ICS. The brokerage grew its revenue by 22%.
Revenue, so everything's great. Revenue's up.
And maybe that was actually, it's 20 in the 20%. Volume was up 2%. So almost all of this was coming from rate increases, right? By volume, and I think the revenue and volume mix that ICS is running is also unique for the size of the brokerage, right? So this is a brokerage that's doing, I think it did $431 million in the third quarter, which is like 1.7 billion run rate.
Right.
But they are 58% of their volume is contracted, but that only amounts to 38% of their revenue.
Right.
And so they're very tilted towards spot for a large brokerage.
Well, and I think important to note is that their contracted percentage of their portfolio declined year over year in the third quarter from, I believe it was roughly 65% in that range of their total spot to contract mix in terms of overall volumes, and it declined. So again, they're going out, they have to go out to the spot market at this point and try to, really recover some of their losses on their contracted freight. And one of the big questions that we've had, I've had over the last couple of weeks here is, what is the ideal scenario for contract versus spot mix? You're in a 2018 type era where spot freight is plentiful, rates are super high, you've got a lot of rate pressure sitting out there. So all this ad hoc transactional freight is basically knocking down your door, and you can play that. You don't have to worry about covering a bunch of old contracted accounts, like you said, where your margins get completely squashed in that business line. Managed transportation in a soft year is a great hedge. 2019, we had this transition to a year where rejection rates were down around 4 or 5%. Carriers were basically begging for freight.
People were selling like dedicated services super aggressively.
Exactly. So now you have all these managed trans accounts that they're easy to manage. You're just basically going to say, hey, can you cover this freight for us today? Well, now with a broker that doesn't control assets traditionally, they have to go out and they've set their rate level, for each of these accounts, $1.60 a mile. Now we're averaging over $2.50 a mile in the spot market. So you do the math. And the carriers are basically rejecting their freight just like they would a shipper's freight, and probably more so considering that the relationship with brokerages is not as valued as one of the traditional shippers.
That's right. To secure service, Hunt is going to have to pay through the nose, right? I mean, even more than, like you said, even more than with a shipper. And what that's meant, though, is that their gross margin percentage declined year over year from 12.7% to 7.6%, which is quite thin, honestly, and not enough to make ICS profitable. Right. So the losses, and they've been, just to give some context, ICS has been undergoing like a digital transformation toward JB Hunt 360, investing a lot of money in technology, in kind of converting a lot of their business from sort of manual brokerage onto their platform, and providing incentives and things to do that. But the sort of the net loss went from like roughly 5 million to roughly 18 million year over year.
Right.
For the third quarter.
For the quarter.
Which is a lot.
So I mean, what would you say to a brokerage that's struggling to answer the question? Okay, I came out of 2018 spot heavy. I built up a bunch of contracted business in 2019. Coming out of 2018, and now it bit me again. So we've had the pendulum swing violently every year for the last 3 years. What do you think the right direction would be going into 2021? Still a lot of uncertainty in the marketplace involving the virus and elections and all sorts of things.
I mean, I think for sustainable growth as a brokerage, what you need is internal technology that allows you to execute contracted freight at a very high level. You have to nail your scorecards, and you have to keep your customers happy, and you have to know how you're doing before your customers do, right? So that takes quite a lot of internal visibility and analytics. So I would say now what they should be doing is trying to grow. And when I say they, not Hunt, but a brokerage in general, should be trying to grow contracted volumes. Like, go to the shippers that are firing brokers, go to the shippers that are firing carriers, and take on that freight. You'll probably get it at a decent price. In terms of building out technology to be like a self-service platform for spot freight, I don't know that, to me, a lot of what that ends up doing is just putting a lot of work on the shipper, where now they're tendering every load. Now they're looking at all these prices and lanes and trying to figure out what they want to do. And I just don't know how, they'll do that when they need to, right? When it's really hard to find capacity, when rate discovery is problematic. But in a soft market, are they going to bother with that? Do they need to? For me, sustainable growth is all about growing your contracted accounts and doing very well at them.
That's what you have. Of course, it depends on the cycle of the market that you take those contracted rates. Well,
Yeah.
thank you so much, JP, for joining me here today, and thank you for watching On the Spot this week. Be sure to check out FreightWaves.com and download that FreightWaves TV app for any future freight market updates. Have a great weekend.